Starbucks, wow. For what felt like, I don't know, 7 really long quarters, the whole story around them just seemed stuck.
Right. Yeah, completely stuck in neutral. They were dealing with staffing issues, service times lagging, pricing seemed confusing to people.
Just falling relevance, it felt like.
Yeah.
All while pouring, well, billions into this massive plan they called the Back to Starbucks turnaround.
That's the one.
Welcome to the Deep Dive. Today, we're looking at all the sources from their fiscal year 2025 Q4 earnings call, their financial results, and we're asking the big question, really.
Which is?
After spending all that money, is this Back to Starbucks strategy finally, translating into real, actual business momentum? That's our mission.
Yep. Let's unpack the evidence.
Okay, let's do it.
And we have to start with the headline, because you just can't understate how big this is. Starbucks delivered its first positive global comparable store sales growth
The first one.
in 7 quarters. That's huge. A major turning point, clocking in at plus 1%. The slump, officially, is over. Yeah, that 1%, it's more than just a number, isn't it? It feels like a proof of concept. But
Yeah.
to really get what it took to hit that number, you got to look at the money. And
Okay.
that's where the story gets a bit more, let's say, complicated.
Yeah.
Global revenue did grow. It was up 5%, hitting $9.6 billion. So that's the top-line growth management promise.
Okay, good start. But the bottom line, that tells the story of the massive check they had to write to get there. The non-GAAP operating margin contracted pretty dramatically.
Dramatically is definitely the right word. A
Yeah.
contraction of 500 basis points. So for anyone keeping score, that's a full 5 percentage points down,
Wow.
settling at 9.4%. And the non-GAAP EPS followed right along, down 34% year over year to $0.52.
Okay, hold on. That is a staggering drop in profitability. So, as someone listening, you have to ask, was that huge drop worth getting that 1% sales growth?
Well, see, management basically said this would happen. They anticipated this exact dynamic. They kept stressing, that they were prioritizing fixing the customer experience, the partner experience first.
Right.
Think of it like a huge house renovation. You spend months fixing the wiring, the plumbing,
Yeah.
the operational
Yeah.
foundation.
The stuff nobody sees but is crucial.
Exactly. Before you can even think about painting the walls or boosting the resale value, that 500 basis point margin hit, it was driven by, well, 2 main things. Relentless inflation, sure, but also heavily compounded by the huge investment in labor hours.
That's the green apron strategy core, isn't it?
That's it. They basically paid a fortune in Q4 to claw back that 1% of momentum.
Okay, so let's pivot a bit from that. Let's call it the ugly cost picture and look at where the good news is actually showing up, which has to be North America, right? Their biggest profit engine.
Correct. North America comparable store sales were flat year over year. And U.S. comparable sales were also flat. But digging into why they were flat reveals the tension they're navigating.
How so? I mean, flat sounds, well, flat.
It does, but it's about the components. The flatness in the U.S. came from a 1% increase in the average ticket. So people spent slightly more when they visited.
Okay.
But that was perfectly offset by a 1% decline in comparable transactions.
So fewer visits overall for the quarter. Frequency was still down on average.
Exactly. Frequency was still an issue for the full quarter average. However, this is where the timing of that turnaround strategy gets really critical.
Okay, here's where it gets interesting then. The momentum actually shifted inside the quarter itself.
Precisely. They made a point of highlighting that their U.S. company-operated sales comp actually turned positive in September. And importantly, it was driven by transactions, not just ticket size.
Okay, that is key. People coming back more often.
Yes. And that transaction-driven growth apparently continued right through October. So it signals that those big investments they made over the summer, early fall, they're actually starting to win back customer frequency, which, as you know, is the holy grail in this business.
And the most critical time for frequency is that morning rush, right? How did they do there?
They reported flat morning daypart transactions. Now, flat might not sound amazing, but in the context of the overall quarterly decline in transactions, it means the morning hours were actually outperforming the rest of the day in terms of recovery.
So they're finally getting a handle on those peak hours again.
It looks like it. It's direct evidence that the operational changes, better staffing, smarter scheduling are having an immediate impact right when the pressure is highest. Because if you can't serve people quickly during that rush,
They just go somewhere else the next day.
exactly, they don't come back.
Okay, speed's important in the store, but what about outside? We also need to talk about the U.S. delivery business. That focuses heavily on mobile orders, quick turnaround.
and it just kept booming. It expanded nearly 30% year over year in
Was
Q4.
30%?
Yeah. And get this, that channel alone surpassed $1 billion in sales for the whole fiscal year.
Wow, that's a serious business in its own right.
It really is. It shows that while they were busy fixing the core cafe issues, they didn't, take their eye off the ball when it comes to convenience.
Makes sense.
But not every channel saw this positive shift. If we look at the licensed business, think grocery stores, department stores, travel spots,
Right.
that revenue actually declined.
Huh. Why would licensed stores decline when the main corporate stores are starting to recover?
Well, the sources mainly point to negative trends in the grocery and sort of general retail channels, which, raises an interesting question for you listening. Is this consumers maybe shifting their at-home coffee habits away from Starbucks' premium stuff in the grocery aisle? Or is it just normal volatility in retail?
Good question.
They did note, though, that high-traffic travel spots, like airports and also university locations, were still bright spots. So it seems like location and maybe the format being right for that specific place is really critical for resilience there.
Okay, so this North American recovery, it seems like it all hinges on one big initiative we keep hearing about.
Yeah.
The Green Apron Service Standard. We've heard about it for a year, but Q4 was the big one, right? The system-wide rollout across all U.S. companies' stores starting in August.
That's it. And this is exactly where that margin contraction starts to make sense. The Green Apron Standard is, well, essentially it's a promise, a commitment to investing more in staffing, more labor hours, all aimed at reducing stress on the partners, the baristas,
Right.
and improving that connection with the customer. It's basically the cost of rebuilding trust.
And internally, it seems like it's working.
Right.
They mentioned Q4 saw record low hourly partner turnover.
They did. And customer experience scores also improved. So for you listening, that translates to fewer brand new hires still learning the ropes, which should directly lead to faster, more consistent service.
Makes sense? Happier staff, better service.
Absolutely. And they didn't just add staff, they also tackled access. To really win back that morning crowd, they extended operating hours for about half of their U.S. company stores. Nearly all U.S. stores are now consistently open at or before 5 a.m.
That sounds like a huge logistical undertaking. Do we know how much extending those hours actually cost them in Q4? And did the extra business fully cover that added labor cost?
The sources don't break out that specific dollar figure, no. But that big 500 basis point margin drop strongly suggests the costs, at least temporarily, outpaced the revenue they generated from it.
So it's a strategic loss leader for now, betting on long-term gains in visits later.
Exactly. They're playing the long game. And to make those extra hours actually work efficiently, they deployed some major tech. The Smart Queue sequencing algorithm.
Right. Smart Queue, that's the system that organizes all the orders, right?
Yeah.
Drive-through, mobile, cafe queues, keeps things flowing.
That's the one. And the results seem pretty tangible. Since they rolled it out, over 80% of their U.S. company coffee houses had cafe service times averaging 4 minutes or less.
Okay, 4 minutes or less. That sounds good.
And what's impressive is they achieved that even while transaction volumes were picking up after the fall launch. So they maintained speed even as they got busier.
That focus on structure, on efficiency, it sounds like it's now getting baked into how they organize things for the future, too. For fiscal 26, they mentioned simplifying store-level reporting dramatically.
Yeah, cutting down from, nearly 24 operational metrics down to just 5 key KPIs.
5. That's quite a cut. But doesn't that raise a potential issue? I mean, simplifying is good, but could cutting 20 metrics also be seen as maybe reducing oversight or even masking weaker areas?
That's a fair point, a valid tension. Management's argument, though, is that those 24 metrics often ended up contradicting each other or just fragmented everyone's focus.
Okay.
So by drilling down to 5 core things, customer, partner, transactions, inventory, and food safety, they're trying to ensure every manager is driving the same key outcomes, specifically transaction growth and operational quality.
So less noise, more focus on the customer right in front of you.
That seems to be the genuine goal, yeah. Empowerment and simplification. And they're pairing this with plans to scale up the assistant store manager role, building up their leadership pipeline for the future.
Right, building bench strength. Makes sense.
Okay, but we can't really talk about optimization without tackling the tough part, portfolio reassessment. Starbucks basically had to admit they had dozens, maybe hundreds of stores that just weren't cutting it financially.
Or couldn't deliver that better experience they're aiming for now.
Exactly. Couldn't provide that welcoming space or efficient service demanded by the back to Starbucks standard.
And that led to some pretty significant closures, especially in the U.S. They reported 107 net store closures globally in Q4. But the really big number was the 627 stores closed as part of the whole restructuring effort.
With over 90% of those being in North America.
That's a lot of stores.
It is. And the impact is real. For the full fiscal year 25, the total North America company-operated store count actually declined by about 1% net.
And these weren't just random underperformers.
No, they emphasize these were stores that didn't show a clear path back to profitability. Or maybe the physical space itself just couldn't be renovated effectively for the modern ways people use Starbucks drive-through, mobile pickup, cafe seating, all needing to work together.
And financially, this painful step, it's actually helping already.
Yes, because those closed stores were basically unprofitable drags on the whole system. Getting rid of them is expected to be slightly accretive to operating margins going forward.
So trading some location volume for better profitability and maybe brand consistency.
That's the idea, sacrificing sheer quantity for quality and financial health.
But they're definitely not abandoning physical stores. They're investing heavily in the ones that remain. This uplift renovation program seems to be speeding up.
Yeah, they completed nearly 70 of those uplifts just in Q4, focusing on big, high-volume areas like New York City and Southern California. And the long-term goal is huge, over 1,000 uplifts by the end of fiscal 2026.
And this isn't just like a quick paint job and new chairs, is it?
No, it sounds like a complete overhaul.
Yeah.
Redesigned layouts for better mobile pickup flow, more efficient work areas for the baristas, and better seating for people who actually want to stay. And at the same time, they're rethinking the building itself, piloting a new coffeehouse prototype that has lower build costs and uses space more efficiently. They mentioned converting a pickup-only spot in New York into a small format version of this new prototype as a successful test.
Interesting. Smaller, cheaper, maybe faster to build. And we shouldn't ignore the gear inside either. The Clover Vertica brewer rollout. That's for fresh brewed coffee, right?
Crucial for that. Delivering a consistently fresh, high-quality cup of drip coffee, that rollout is going to be nearly complete in U.S. company stores by the end of Q1 26.
Yeah, you can fix the staffing, fix the layout. But if the basic brewed coffee isn't great...
that core morning customer might still go somewhere else. You got to nail the fundamentals.
Okay, so operations improving, store fleet getting healthier.
Yeah.
But people still have to actually want the product. Starbucks is reporting some meaningful market share growth, and they're attributing it to a much sharper focus on marketing and menu innovation.
Yeah, a more disciplined approach. It kicked off late September with those protein cold foam and protein lattes.
Right.
And what's strategic there isn't just the new flavors, it's the platform that protein add in. Apparently, it can be put into over 90% of their existing drinks.
Ah, so it's innovation that enhances what they already have, rather than adding totally new complex things to make.
Exactly. It leverages their current inventory, their current training, maximizes throughput while still offering something new that customers might want. Smart.
And looking ahead to fiscal 26, they're not easing up. Plans for an up-leveled bake case, new artisanal bakery items. Sounds like they're trying to boost the food side of the business.
Seems like it. And also continued optimization of the matcha menu, which has been popular.
And of course, you can't forget the holidays. Q1 26 means the return of the classics, right? Peppermint mocha.
And they specifically mentioned bringing back the eggnog latte, a fan favorite.
Always gets people talking. But okay, product is only one part of the value equation. Management is claiming that the perception of value actually got stronger across all generations in Q4.
Yeah, which sounds counterintuitive, right?
Totally. How do you strengthen value perception when you're also dealing with inflation and likely had to nudge some prices up?
It seems it's all about the non-price factors that strengthen perception. They credit it heavily to those investments in Green Apron service, just getting faster, friendlier service, feels like better value.
Okay, the experience itself.
Right. But they also made some tactical changes people feel right away, bringing back the self-serve condiment bar.
People miss that.
Definitely. Simplifying some confusing pricing structures, and critically, they removed the extra charge for non-dairy milks.
Oh, that's a big one. That was a constant complaint online.
Huge move. Addresses a major customer pain point, and really changes the perception of how accessible it is to customize your drink. Makes them seem less like they're nickel and diming you.
Good point. Okay, let's switch gears quickly to international. That's a massive part of their future story, and it sounds like it's holding up well.
Yeah, really resilient. International revenues actually hit a record $2.1 billion in Q4.
Wow. And the main driver there has to be China, right?
Absolutely. China delivered its second positive quarter in a row, 2% comp growth overall. But here's the really encouraging part. If you break down that 2%,
Yeah.
it was driven by a strong 9% increase in comparable transactions.
9% transaction growth.
Yeah.
That's huge volume growth in their second biggest market. What's driving that frequency boost in China?
Product innovation, especially stuff tailored locally. They saw a huge success with a new tea latte lineup, something that really caters to the regional taste profile.
Makes sense.
And China's not some small side project anymore, right? They have over 8,000 stores there now. Showing sustainable, transaction-led growth there is serious proof that their global strategy can be adapted successfully locally.
And globally, they're still expanding.
Full speed ahead. Opened 316 net new coffee houses just in Q4. That brings the total to over 900 for the entire fiscal year. And they're being strategic about it, planting these sort of brand-building flagship locations, like the one inside the famous Santiago Bernabeu Stadium in Madrid.
Wow, cool location. Okay,
Mhm.
so after this deep dive into the results, the core takeaway feels pretty clear, doesn't it? The pain, the big margin hit that came with the Back to Starbucks plan,
Yeah.
it's finally starting to generate some real measurable momentum.
Yeah, you can really see that crucial shift happening. They're moving away from just playing defense, fixing
Right.
staffing gaps, fixing the order sequencing.
Right, plugging holes.
Exactly, to being more on the offensive, focusing on higher customer connection, and most importantly, seeing that positive transaction growth start to come through.
That feels like progress.
Absolutely. And management kept reiterating this is a multi-year turnaround. They're committed to making sure this growth is durable, sustainable. You can see that confidence in their actions, too. They announced their 15th consecutive year of dividend increases.
That's a pretty strong signal to the market, isn't it? Saying, we believe these investments, even though they're costly now, will pay off long term.
It's a very powerful signal. They believe this investment-heavy period will ultimately generate substantial returns down the road.
And the source material really hammered home that this whole turnaround depended on fixing the basics across all the ways people access Starbucks, right? Simultaneously.
Yeah.
Drive-through, mobile, the cafe itself, delivery.
All of them needed attention. And they reminded us Starbucks already has the biggest share in the U.S. for drive-through coffee, mobile coffee, and traditional cafe coffee businesses. They dominate those access points.
Right. Which brings up a final thought for you, the listener, to consider. They've poured all this money into lifting the quality, the speed, the throughput of the traditional cafe, and we saw delivery grow an incredible 30% year over year. So looking forward, which of these access points, now that they've all received this focused investment, is going to be the dominant growth engine for Starbucks? Is it going to be the revitalized, more welcoming cafe, bringing people back inside for that experience? Or is the future just inevitably driven by the pure speed and convenience of the mobile app and the delivery driver?
That's a fascinating dynamic to watch now, isn't it, as those investments hopefully start to move into harvest mode. Well, thank you for joining us for the deep dive.
Catch you next time.